Hi, this is Russ Ryan from King and Spalding, and my next big thing for Securities Enforcement West is a prediction that we're going to see major developments in the area of insider trading law soon. We have a bill pending in the Senate that passed the House overwhelmingly that would codify insider trading law for the first time. We had a major decision in the Blasik case in the Second Circuit, which, if it stands, will make it much easier to prosecute criminally insider trading cases. And you're seeing the defense bar now starting to raise some old arguments of due process, fair notice, and the rule of lenity. And I think they may get some traction in the courts. So stay tuned and enjoy the conference. Thank you.
Welcome back. The next panel is unique to Securities Enforcement Forum West. Instead of looking at issues through the lens of a specific regulation or enforcement initiative, this panel views enforcement through the lens of industry, specifically the complex world of Silicon Valley. And to moderate the panel, we have Shannon Eagan, a partner and the Northern California head of Cooley's business litigation practice. Shannon has been a leading SEC defense attorney in Silicon Valley for almost 2 decades and has built an impressive reputation, especially in emerging technologies and sciences. And in fact, she played a role in some of the most significant disputes impacting Silicon Valley, including disclosure of clinical data by life science companies, and also stock options backdating issues. Welcome, Shannon.
Thank you, Bruce.
From the SEC, very pleased to have SEC Associate Director Monique Winkler, sorry, Monique, who oversees the San Francisco office's enforcement efforts for Northern California and the Pacific Northwest. During her more than a decade-long career at the SEC, Monique has investigated or supervised cases against Theranos, Elizabeth Holmes, LendingTree, KeyGen enforcement matters, all local actions with global ramifications. And so as the regulator overseeing enforcement in Silicon Valley, Monique is an ideal panelist. Monique, congrats on your recent promotion, and thanks so much for being part of the forum.
Thank you.
Next up, Josh Newville, partner at Proskauer, who spent 6 years in the SEC's enforcement division. Also, Josh has become a virtuoso with the virtual backgrounds. We'll see what he sticks with. Looks like he's got Switzerland now, but a minute ago was a sauna and a Zumba class, and we will see where that goes. But Josh's specialty is handling all aspects of SEC regulation on the asset management side, having served in the SEC's Specialized Asset Management Unit. And given the critical role that private equity plays in Silicon Valley, Josh is great for this panel. So, Josh, thank you so much for being here and welcome.
Thanks, Bruce.
Boris Richard, of course, our last panelist here. The juxtaposition of law, business, and technology is ever present in Silicon Valley, which is why Boris rounds out this panel so nicely. His experiences range from bond research and trading at major investment banks and hedge funds, an analysis of RMBS structured products and interest rate derivatives, all the way to the valuation of cryptocurrencies and the operation of crypto exchanges. So really happy to have you on board, and welcome, Boris.
Thank you very much, Bruce. Happy to be here.
All right, let me turn this over to Shannon. Take it away.
Thanks, Bruce, again for having us, and welcome everybody. Today, as Bruce said, we are going to cover shareholder litigation and enforcement in our backyard here, Silicon Valley. We plan to talk about the issues that cover private equity and the venture capital ecosystems that are all around us, recent cases brought by the SEC's San Francisco office, some lessons for private companies and board members, and even some predictions. So Boris, let's start with you and take a look back at litigation and enforcement in Silicon Valley. Where have we been over the past few years, and where are we in 2020 in this new environment?
Sure, Shannon. Starting from the beginning of 2016, so let me talk about the sort of private securities litigations and the SEC enforcement actions. So the private securities litigation, since the beginning of 2016, they have been on an upward trend. So there were about 66 of them in 2016. Then they, spiked to about 130, both in 2018 and 2019. Year to date in 2020, we have counted about 59 or 60 private securities litigations so far that overall are related to the Silicon Valley or Northern California and San Francisco. So, and in total, it's about 460 securities litigations that have happened over the past 3.5 years. In terms of the Securities and Exchange Commission enforcement activity, I guess that was shaped by Mary Jo White's notable and well-known Silicon Valley Initiative speech that happened in March of 2016 at Stanford University. And that speech focused on unicorns and private companies and the necessity to address and enforce the anti-fraud provisions of the securities law, which are also applicable to private companies, not only to the public companies. So, and within the realm of that initiative, again, there were about 8 SEC litigations, brought, related to the Silicon Valley entities since 2016. And SEC was also quite active in terms of its out-of-court enforcement actions. So, outside of cryptos, everybody may remember Zenefits, which was sort of the opening salvo in this initiative to enforce the anti-fraud provisions against private companies. That particular enforcement action was, finished in 2017. And in terms of enforcement out of court actions, SEC was also quite active in the crypto space and the blockchain area, and there were several actions like against Munchie, initial coin offering, again Coin Alpha Advisors, which is a hedge fund, also based in that area, ICO Box, and Enigma Decision, which is another token issuer enforcement action. That cease and desist order from the SEC came just recently in February 2020. So effectively across the spectrum, the SEC was definitely focused on, again, private companies and unicorns. The SEC was active and focusing on digital token issuers and cryptocurrencies. SEC was obviously enforcing the rules and going after misdisclosures. Again, we can talk about the settlement with Facebook last year, and I'm sure other participants will talk more about it. And the SEC was also active in terms of the prosecuting and isolating the insider trading cases. So in terms of what happens so far in 2020, obviously the COVID-19 is at everybody's top of the mind, and we have tracked the litigations that has happened so far, and we have counted across the entire United States about 186 litigations that we can track one way or the other to the COVID-19. About a third of them, about 59, are refund class actions. So basically, refund class actions filed against universities, fitness clubs, educational companies, ticket brokers, and resellers. We have counted about 40 class actions against insurance companies. Breach of contract is probably the third largest category, with about 27 of them that we can track to COVID-19. In terms of the securities lawsuits, there were very few of them so far. So we have been able to count only about 9 of them. So less than 5% of the total COVID-related litigations could be classified as securities lawsuits. Again, the panel will discuss, some of these actions and some of these litigations in more detail. But I'm sure that these securities litigation will pick up with some lag. And in addition, some of the crypto-related litigations may also be traced to COVID-19 because as it relates to Silicon Valley, there were at least 2 class actions filed in Southern District of New York with respect to the token issuers that have some domicile in San Francisco area, specifically the Civic token and the Quant Stamp token. And there was a very recent private lawsuit launched against Ripple Labs. So the third largest cryptocurrency issuer, which is also based in San Francisco.
Thank you, Boris. Monique, during the past year or so, what has the SEC's focus been when it comes to Silicon Valley?
Thanks, Shannon. Before I start, I need to give the usual SEC disclaimer. The views I express today are my own and not necessarily those of the Commission, individual commissioners, or my colleagues. So I'll talk about a few cases that the SEC has brought in connection with Valley-related companies in the past year or so. And maybe first starting with what is probably the hot topic today, actions the SEC has taken with respect to COVID-19 disclosures. The SEC has brought one trading suspension related to a Silicon Valley company. I'm sure this will be covered by other panels, but I want to briefly mention it. In April, the SEC temporarily suspended the trading of the Silicon Valley company Arrayit because of questions regarding the accuracy and adequacy of publicly available information in the marketplace, including information claiming that Arrayit had developed an FDA-approved COVID-19 blood test. Outside of Silicon Valley, the SEC has also suspended the trading of multiple other companies, and in at least one instance, that COVID-19 related trading suspension was followed up by an SEC fraud action. I do think we could see more of that happening. Next, I'll turn to a case against Marvell Technology that the SEC settled in September of 2019. That was a revenue management case. In that case, the SEC alleged that Marvell misled investors when it engaged in an undisclosed revenue management scheme. The scheme involved pulling in sales to 2 quarters that had been scheduled for future quarters to close the gap between actual and forecasted revenue and to meet publicly issued revenue guidance. The SEC alleged that Marvell did this to mask a substantial decline in customer demand, a loss of market share, and reduced future sales. This is an area, I think, particularly given the current market conditions, the SEC will continue to focus on in Silicon Valley and outside of the Valley. And next, I think, as Boris had briefly alluded to, the SEC's Facebook case in the data privacy space that was settled in July of 2019. That case involved Facebook's misleading disclosures regarding the risk of misuse of Facebook user data. In that case, the SEC alleged that Facebook's public disclosures presented the risk of misuse of user data as merely hypothetical when Facebook knew that a third-party developer had actually misused Facebook user data. And then lastly, I'll talk about one other topic, and that's insider trading. Again, I think this is the focus of another panel, but it's worth mentioning here. At the end of 2019, the SEC brought a case against a Silicon Valley company insider and several of his friends. The SEC alleged that the insider, who was a former IT administrator at Palo Alto Networks, had abused his access to obtain highly confidential information about his employer's quarterly earnings and financial performance. So not only did he trade, then he also tipped his friends. As part of the allegations there, the SEC alleged that certain of his friends kicked back trading profits in small cash transactions intended to avoid bank scrutiny and reporting requirements. Again, not conduct that we see that's isolated to Silicon Valley, but I think a very important part of what the SEC does and looks at with respect to conduct by Silicon Valley insiders and companies.
Thank you. Thank you so much, Monique. Josh, as we mentioned, it's been 4 years since Mary Jo White shared with us that the SEC is focusing on Silicon Valley and in particular unicorns. From your perspective, what are the key lessons from that focus? And is this SEC still looking at the private companies in our backyard?
Thanks, Shannon. I think we can take a look at the topics that Mary Jo covered in that speech. She looked at fintech, including blockchain-based technology, which was really kind of in its infancy. We've seen an explosion of cases in that area. She was focused on gatekeepers in kind of the industry and the ecosystem. So secondary market trading of pre-IPO companies. We've seen some activity there. Crowdfunding, focusing on gatekeepers in those fields. And I think, as you mentioned, the real takeaway was for unicorns and pre-IPO companies, what's their corporate governance structure? What kind of financial controls do they have? Really focusing on whether the financial information that those companies provide is accurate and free from fraud. and particularly focused on valuation issues. So has there been a focus on enforcement involving private companies? I'd say somewhat. The illustrative case here is the Jumio case that was brought last year, private company. So this is a settlement last year against the company and its founder, a private mobile payments company. The allegations were that they misstated the company's financial results. They engaged in round-trip transactions, kind of garden variety accounting chicanery, but there was a lot of interesting facts in that case. The interesting thing is, the claim was that the founder used those financials not for the next funding round, but to sell his own shares on the private market. So what you got are, claims of, around a private company, a VC-funded company, engaging in private securities transactions with individuals. And really, it's a reminder there that those types of transactions are not exempt from regulatory focus and regulatory scrutiny. The types of potential claims that we might see going forward, really all boils down to fraud-based claims. And for unicorns, really we're at the beginning stages of what may be a longer market downturn. So companies in the space and VC firms are really preparing for the prospect of down rounds in funding, kind of an era of diminished expectations on returns. And some of the weaker performers, really may be edged out, and whether they're sold or whether they're facing liquidation, as that happens, we're going to see more potential for disputes and enforcement action involving those types of companies. And in particular, I want to focus on, the VC firms and those that may have directors sitting on the board of private companies. That is a key area where there's a lot of different potential areas of conflict. Fundraising for private companies is really a key area where problems can occur. And we may see a difference between a blow up like Theranos, which, I'm sure Monique has some experience with, and situations where kind of the air slowly comes out of the balloon for some companies. And in that second type of situation, you may have really tough fundraising issues. There could be a high likelihood of focus on decisions that were made and whether people were pushing the envelope as they tried to keep a company going. Really, you've got issues where, if a company is in, the zone of insolvency, there may be differing fiduciary obligations to lenders and equity holders and potential conflicts there. And those are some of the areas that I think the SEC is going to be focused on.
Yeah, Josh, we're seeing in this time of market downturn some new rules or relaxing of the rules from the SEC. Can you touch upon those and tell us what you're telling your clients about them?
Sure. I mean, the SEC is giving some relief to help companies access the capital markets more quickly and with less regulation. Those are the types of situations where you could see enforcement interest down the road. The SEC just announced within the last week or two that they were officially relaxing some of the crowdfunding rules. So through the summer, that may allow crowdfunding without audited financials. In some cases, you can go out and crowdfund before financial statements are provided, and companies can raise the money sooner without waiting periods under the rule. The SEC also approved changes to the exchange rules, basically approving temporary lifting of the 20% rule, which may permit public companies to raise capital more quickly in light of the pandemic. So there's a temporary exception from the shareholder approval requirements for private issuances that are below the market price, that are 20% or more of the outstanding shares of the company, that if the company can show they need funds because of the pandemic. So that's until the end of June currently. A couple observations on this. I mean, on crowdfunding, you know, my sense is that the whole crowdfunding system is pretty sparsely used at this point. You know, why crowdfund if there's easy VC money available and there's a lot of dry powder out there? The second observation is that, you know, anytime you have regulatory guardrails that are relaxed, particularly when talking about small cap companies, and that's what we're talking about here. These are not tools that would be used by you know, Amazon or large cap companies. You know, for small caps, there's an increased risk of fraudulent conduct, and that's just one of the trade-offs. When you reduce regulation, you have increased risk. And so with each of these moves, you're likely to have offerings that would not have occurred before. Or if so, it would have been after additional time. And, you know, for example, for the 20% rule, a shareholder vote. It's understandable why the SEC would want to relax these rules. And, you know, many small issuers will legitimately take advantage of them. But you have to expect that there's going to be some potential for abuse that will result in, you know, greater risk of enforcement action and potentially fraudulent conduct. I think one other observation is that for both public companies and private companies, valuation issues are really at the core to these potential disputes. You know, for private companies, you can have the same potential accounting issues as you have in public companies, the types of issues that Monique mentioned in the Marvell case, revenue management, other accounting issues. Another case in point is that fund managers now may be holding illiquid investments really for longer than expected time periods, and valuation risks really kind of increase as the time lengthens between the investment and the exit. You know, can valuations that you go out with to fundraise, can those simply track the last round of funding? I mean, even if it's not a down round of funding, you could have a situation where that valuation may not reflect fair value if there are things like structured terms that only benefit the later investors, whether that's preferred returns or liquidity rights or things like that. You can have companies that could go out with, you know, adjusted financial measures, even if they're private companies, like an adjusted EBITDA measure. You know, in those situations, I think process and disclosures are really key.
Thank you, Josh. Monique, let's stay on Josh's point about valuation and representations with respect to valuation. Are there SEC enforcement cases that you think sort of drive home that point that you can shed some light on?
Sure. I think the case that Josh mentioned, the Jimeo case, is a great case to demonstrate that. You know, as part of that, the allegations in that case, the CEO substantially overstated the revenue of the company, claiming that it was well over $1 million. And in fact, it was under $10 million. He claimed that there was a net profit, made other representations related to the valuation. So I think the Jimeo case is a great case on that point. Also, I think Jimeo is a good case to point out for another reason. It highlights the fact that investors want access to pre-IPO shares and that there's a secondary market for those pre-IPO shares. This area is ripe for abuse as well, and that's another area that the SEC is focused on in the Valley.
Yeah, I think the facts of that case I found to be pretty remarkable, at least based on what I read. You know, making the CEO made up the financials and obviously, you know, had to pay a pretty hefty sum for doing so. Monique and Josh, you can't cover Silicon Valley without touching upon the venture capital and private equity aspects of the ecosystem here. Josh, what are you seeing from the SEC in this area?
For VC managers, I'm really focused on fundraising and marketing, particularly claims regarding performance based on unrealized gains. And there, that's really an interplay between the valuation issues we've been talking about. I took a look at a recent valuation survey of private fund managers, and there's some interesting data points there. So 80, and this was in light of the pandemic. What are they doing? 80% of those respondents said they're going to primarily rely on public market comparables, along with other metrics that they look at in order to analyze how the pandemic will affect valuations for their portfolio company. But the interesting thing was for recently acquired investments, so those made within the last 12 months, close to 70% of the respondents said that they're just going to hold those investments at cost. And what industry the portfolio company is in really matters here, depending on how they're affected. But I could see some concerns there, because when you look at the independent valuation guidelines and probably the internal valuation guidelines of many funds, they say that using a cost basis without taking into account changed circumstances and economic circumstances is really incompatible with the concept of fair value. So, there are some potential risks there. In the fund space, I don't think the SEC normally challenges valuations of level 3 assets per se. Say we don't agree with this valuation, you should use this number. But they really do look at policies and procedures and disclosures. What did you tell LPs about how you were valuing your position? What do your internal procedures say? Did you check all the boxes, and did you do all the things that you said you were going to do when you put together those procedures? And did you do that for investments that were even facing some sort of liquidity or economic crisis? Another area that we could potentially see is MNPI. Could see a focus on whether funds have adequate controls regarding MNPI and insider trading. For VC advisors, they're exempt from a lot of the rules, but they're not exempt from the anti-fraud rules, and they're not exempt from the requirements under 204 Cap A of the Advisors Act to have adequate policies in place to prevent misuse of MNPI and insider trading. And we've seen at least one recent case on the failure to maintain adequate policies and procedures regarding MNPI. That's the Canal Capital case from earlier this year, where the company just didn't have robust procedures regarding potential misuse of MNPI. The final area that really we focus on for fund managers is fee and expense disclosure. There was a case last year, the Frost Management case, against a VC fund manager involving incubator fees that were paid by the startup companies to the fund manager or its affiliate. And really, it's kind of circular. The fund would loan money to the VC companies. The VC companies would pay incubator fees back to the manager. And I think in the SEC's view in the settlement was that the manager was really just kind of utilizing money and doing round trip transactions like that. From the SEC's perspective, if a particular fee or if a particular practice wasn't disclosed in detail in the LPA or in the PPM that was given to investors, or if it wasn't specifically consented to by the LPs or the LPAC, if you have one, then the SEC may allege that's undisclosed compensation, and that a fund manager has a non-waivable conflict of interest and can't consent to that practice on behalf of the LPs because it's compensation directly to the manager. So those are areas that we're focused on and talking to clients about.
Yeah, I thought that, the theory there also about the conflict of interest that was presented, so that these excess fees that were charged to the startup companies essentially weakened their financial positions and their prospects for success, which then harmed the funds that Frost Capital was advising. I thought that was, that is obviously something that the SEC is paying careful attention to as well. Monique, tell us about the Monomoy case and sort of the similar lessons related to disclosure and conflicts and what we should be taking away from that case.
Sure. Not a Silicon Valley case, but I think the message is certainly applicable there. This was a very recent case. April 2020, the SEC announced settled charges against a New York-based private equity fund advisor for failing to fully disclose or obtain consent to its practice of charging private fund portfolio companies for the costs of certain services. According to the SEC's order, Monomoy charged portfolio companies for the services of its operations group, which then allowed Monomoy, the advisor, to recoup most of the charges or the costs of maintaining that group. Monomoy did not provide full and fair disclosure about these charges, nor did it obtain consent to the associated conflicts of interest. The charges that Monomoy charged for the operations group actually were not the problem or the focus of the case. It was the lack of disclosure about the payment arrangements and the associated conflicts of interest that could arise. So that was the message there. I think that's the message that should be the takeaway for actors in this space.
Yeah, and Monique, just one additional point on that. If we're faced with differing market circumstances where the large institutional investors are looking to pull back some of their commitments to funds, and fund managers are looking at their operating expenses going forward and thinking about, well, how do we recoup some of this? There's always a potential motivation to put more onto the funds or the portfolio companies than you might otherwise have. So, that's an area to continue to think about.
Absolutely. So, Josh, what advice are you giving to folks who are sitting on boards right now? So there's a lot to think about here, particularly in this environment. What are you telling people?
I think for fund managers that have board representation, you really have to look out for conflicts of interest. Wearing two hats, you've got competing obligations to the fund and competing obligations to a portfolio company. You've really got to manage those risks carefully and think about them. Increased control of a portfolio company really means increased responsibility, where you may potentially be on the hook for certain types of claims. If you're a board designee, the fundraising and valuation points for a particular portfolio company really kind of have at least three different angles. Number one, you can have issues surrounding the company itself trying to raise money and make its next round of funding. You could have board members themselves talking to existing investors about new funding for a company. And then you can have the fund itself, if you're a fund manager designee, using valuations when they're raising money from their LPs or prospective LPs. So your board designee is really kind of in the middle of that, hurricane on all three of those issues. And that's particularly true if there's control by the fund over the portfolio company. So those competing fiduciary obligations are key. And in particular, if you've got different types of investments in different parts of the capital structure, where somebody could claim that, for example, you're bringing in a loan to support the equity investment. That's where we can see conflicts, and we hope that people are talking to counsel about those. Yeah,
absolutely. I mean, in this area, of course, with respect to breach of fiduciary duty, there are some breach of duty of loyalty claims that might be made here, and that's when I would be telling board members you need to be very careful about personal exposure. Some of the things that we're talking to our board members about are obviously thinking about whether companies, both private and public, should have Delaware forum provisions, and thinking about where you'd like to have battles with your shareholders, if they are in fact, on the horizon. And also, something I would tell people about is there are some new Caremark cases coming out of Delaware that people should be paying attention to. You need to be implementing reporting systems, and you need to be monitoring them. And so the Bluebell case and the Clovis case are things that we've seen in the last year and really taken note of. So with our last few minutes, let's talk about where we think things are going moving forward. Boris, you sort of started us by saying in the securities enforcement and shareholders in this COVID-19 world, we haven't seen a lot yet, but I think we're just getting started. Where do you think we'll see some action?
Absolutely. I think, let me briefly talk about the trend that I see that are directly related to the collapse in some of the valuations because of the COVID-19 pandemic, and talk about kind of longer term trends which are shaping up because of technological changes in the industry, especially in the Silicon Valley and in North California. Number one, there is definitely quite a bit of pain in the hedge fund industry that have been related to the COVID-19, especially if you look at the hedge fund composite index. It was down by almost 9% in the first quarter of 2020, and March alone, created negative 7% returns for the hedge fund industry. There were large outflows of capital from the hedge fund industry because of the pandemic. And some of these strategies, in particular event-driven strategies, those hedge funds lost in the first quarter of 2020, 15%. So, a pretty difficult period for some of the sectors of the hedge fund industry, and that may, create incentive from the shareholders or investors to go after, the performance, and why certain strategies that did not work because of black swan that happened in March. Number two, there is quite a bit of pain in some sectors of the real estate investment trusts. If you look at the FTSE National Association of REITs index, the mortgage REITs, they lost about 45 to 50% because of their exposure to non-agency mortgage-backed securities, those that are not guaranteed by Fannie, Freddie, and Ginnie Mae. Some of the losses are related to the illiquid commercial mortgage-backed security that sit on the books of those REITs. And there is also quite a bit of pain in REITs that have been investing in shopping malls, anything related to retail, as well as the REITs that were investing in lodging. So again, for obvious reasons, and those REITs are down by 45, 52% year to date. So that's definitely COVID-related, trend that we see that may create incentive for private litigation, as well as increased regulatory scrutiny of those entities. Unicorns will remain a focus of the enforcement action and oversight, because again, especially in San Francisco and Silicon Valley, you have a lot of unicorns that could have come to market with IPOs. We're talking about DoorDash, we're talking about Instacart, Postmates. The Airbnb obviously had to delay the IPO. So, because these companies are either rethinking their strategy, they will be scrutinized for the investor disclosures, for the valuations, for reporting. Some other, pre-IPO entities like Robinhood, right, the app-based stock brokerage company, they are actively raising funds from the private capital. And again, that, in lieu of the IPO process, that creates also, the incentive for more scrutiny of those entities as they move through, the fundraising process. In terms of COVID, I would also point out some troubles that may be brewing in the private debt funds. So basically, funds that invest in loans to smaller companies. And again, we all know about the enforcement action that the SEC brought against the direct lending investments in the LA area in 2019. We know overall that the SEC brought 4 enforcement actions over the past 2 years against the private debt funds, and in those, claims included ignoring loan losses, falsifying borrower payments. In difficult times like these, when the credit performance is key and the oil prices have been plummeting, again, there will be more scrutiny over the performance and the related disclosure surrounding that performance, which is pertinent for the private debt funds. In terms of the longer term trends, kind of moving outside of the COVID, I think as it relates to the Silicon Valley and North California in general, I would say there will be more scrutiny on the cryptocurrency mining companies because they are growing in popularity. There is a lot of investment in cryptocurrency mining operations occurring in the United States, not only outside. There are some large cryptocurrency mining companies based in San Francisco. So obviously, we all remember the insider trading investigation that was brought into the Riot blockchain back in 2018. So again, to the extent that this cryptocurrency mining business is getting bigger and attracting institutional investor and private funds, that sector, will be scrutinized from a regulatory perspective. And I believe that insider trading policing will remain a focus, and that also includes some of the crypto businesses, because to the extent that the SEC is deeming certain tokens issued in the digital space as securities, then obviously that raises the possibility of insider trading investigations into public blockchains and the tokens that are issued by those public blockchains, because there's a lot of material information that blockchains, may have at their disposal that may affect the valuation of tokens that may be, deemed to be securities under the federal law.
Thank you, Boris. We've got a question from the audience. Do you expect more SEC focus on fintech and marketplace lending entities given these disruptions? Does anybody want to take that one? Monique says yes.
I'm sorry, Shannon, I didn't get the question. Can you repeat?
Oh, sure. Do you expect more SEC focus on fintech and marketplace lending entities given the current situation?
Let me start, and I'm sure that other panel participants may chime in. I think what we have seen through the pandemic is the explosion in the interest in the crypto-backed lending. So you can call it a marketplace lending too, and again, because of the collapse in the equity valuations, especially in March, people or retail has been taking out more loans collateralized by their crypto holdings, which we did not want to sell. So the crypto lending platforms have been becoming more and more popular, and I think the pandemic has intensified that trend. And when you go to the western part of our country, again, some of those crypto lending platforms are based in San Francisco, and from that perspective, to the extent that the issue of the disclosure and the issue of consumer protection pops up when we talk about those crypto collateralized loans, I would definitely say yes. The regulators will probably have a bigger interest in those types of that type of industry. Absolutely.
Yeah, I think in particular there are a lot of industries here that are going to be hit with market volatility, given the nature of the life science companies that are based here, the technology companies that are based here. And Monique, in preparing for the panel, you said that given the market volatility, you certainly would think that the SEC would be watching that. And so, we're going to wrap up right now, but I would think, any parting words, insider trading may be something that I would think continues to be a focus.
I don't know that I would narrow it down to one area, Shannon. I think that it's something that the SEC will look at through maybe sort of a different lens in light of the COVID-19 pandemic and what the changing market conditions. But I don't think the focus will ever be off of what the companies in the Valley and what happens in the Valley.
Great. Well, thank you, everybody.
Thank you, Shannon.
Thank you.
Really interesting to look at these issues through the lens of Silicon Valley. Our next panel is on big data and AI, and it'll get started at 11:50 a.m. Pacific. Thanks again to the panel. Great job, and we'll be back in a few minutes. Thank you.